The title of your report, I'm just going to bring it up here, Run, Rabbit, Run. China in 2023. Just what's the takeaway here?
Well, the rabbit is a little bit wobbly out of the gate, and we have to admit, right? It's going to be a soft start to the year because we still have the lingering effects from, of course, the infection spike, for example. Now, there are some green shoots here. We know over the Chinese New Year holidays, we saw a bit of pickup in travel, for example. But make no mistake, it will take a couple months or so before we really see the economy start to gain traction. And we think, rabbit might actually gain some speed over the course of the year, and by the second half we're going to see that rabbit catch the carrot. It's going to be a better year than the year of the tiger, for sure, for China, but then also, of course, for the region, because the Chinese economy matters so much for the region as well. So it's going to be an acceleration over the course of the year, and the markets are reflecting that as of today.
A positive tone, as you point out. Macro messages are positive: equities, bonds, and FX. Everyone talks about consumption, catching that carrot, using your analogy. Is this consumption recovery, I mean, is this going to come to fruition as everyone expects, or are there going to be bumps along?
Well, the consumption is the obvious, right? Everybody talks about the travel resumption. You know, book your flights now before the holidays are all booked up. But there's a second big driver as well, and that's property. And that's sort of been a little bit overshadowed by the headline news, because remember, we see an extraordinary property market recession in China on the construction side, on the sales side. If you just stabilize that, you just already going to get a strong growth impulse, and you might actually see some positive growth coming through there. So it's really the twin engines of property market and consumer spending coming back. There are some drags here. Exports, for example, maybe some local government spending will be curtailed, but that's the two legs the economy will need to stand on.
To your point, a lot of people talk about how there's just an enormous amount of savings that was built up on these household balance sheets because they were not able to spend on property and spending. What degree of confidence would you attach to them being able to engender not just a property market that remains stable, but a recovery in sales? Because that's another thing altogether.
Yeah, I think we have to be a bit cautious on that. Yes, we like the reopening story. Yes, the rabbit will catch the carrot, and then you would get 5% growth plus. But remember, it's 5% growth plus maybe 5.5% if we're lucky. It's not going to be 7-8% growth, at least in our forecast, because there'll be some reticence among consumers deploying all these excess savings. And in China in particular, a lot of the savings were accumulated by richer households. Whereas in the US, for example, other countries, because of fiscal transfers, it was the middle class that actually accumulate these savings, and they could redeploy them, right? Fuel the consumption recovery. In China, is a bit more the upper class has accumulated that, and they're not going to spend immediately all those savings. Also, there's fewer savings accumulated in China compared to the US, right? Our estimate is about 5% of GDP, which is not nothing, but it's not the 13% plus that you saw in some of the Western economies because of fiscal transfers.
Fred, the whole idea of Run, Rabbit, Run was actually a song written for a play called The Little Dog Laugh. Now, which little dog or little dogs are going to be laughing as the rabbit runs?
Well, it's mostly the Asian dogs who are going to laugh here, because it's a Chinese economy that has the biggest impact really on regional economies. If you think from Southeast Asia in particular is in a sweet spot here. Of course, Korea, we just saw a contraction GDP growth, but they will get some lift from the Chinese recovery. If you go further out, actually, a U.S. economy may not feel the benefit from China's reopening. On the contrary, you could argue that China's reopening puts really a leg up on commodity prices, which complicates the job of the Fed to actually exit. We just had Mark talk about the market pricing in cuts here, potentially at the margin this year. We would actually argue that China's reopening makes it harder for the Fed to deliver any cuts, thereby prolonging high interest rates in the U.S., which is actually not necessarily positive for U.S. growth. But here in Asia, the growth impact outweighs the inflationary impact from China reopening.